Hi, class, and welcome to Chapter 13, Part 2. And this is about savings and investment in the financial system. So, if you remember in Part 1, we were talking about how savings is equal to investment in a closed economy. Now we're going to take a look at how this all works. So, in a market for loanable funds, the supply and demand model works exactly kind of the same as it has up until now. Whether we're dealing with the supply and demand of apples or oranges, there is a supply and demand model for the financial system. And in order to understand this, it helps us to really figure out how financial systems coordinate their savings and investment and how government policies and other factors will influence savings, investment, and the interest rate. So, what am I saying there? I'm saying, okay, if we can understand the supply and demand of a financial system, we can understand how that savings and investment we talked about earlier is coordinated. But we can also understand if you insert in any kind of government policy, whether that be um, savings policy, i.e., the 401ks, or whether or not it be an investment into the economy, or whether it is an interest rate, like for instance, when the Federal Reserve just lowered the interest rate, how do those things affect the financial system in the model? To do this, we have to create a model and we have to create assumptions. And we're going to create the exact same assumptions as we did previously, which means that we're going to have a closed economy. And we're only going to have one financial market. Now, obviously, you could do this with an open economy and a multiple financial markets. But for right now, let's start with a small one, and we can always go bigger if we need to. All the supply savers' deposits go into savings. So, in other words, if a saver has any money to save, they put it into savings in this market. They don't put it anywhere else. They can't put it anywhere else because remember, it's a closed economy, so they can't go outside the United States. All the borrowers have to take money from this market. In other words, they can't borrow anywhere else in the world because it's a closed economy. They can only borrow within it. And there's only one interest rate. So the interest rate that you get on your savings is also the cost of borrowing. Not always true, but it is a good assumption to start with, and then we can obviously start modifying from there. So, the supply of loanable funds, the funds available to loan, comes from the savings of everyone who's saving. So, if a household has extra income, they can loan it out and earn interest. In other words, when we put it into a savings account, we're literally giving the bank a loan of our money. The bank is giving us an interest rate. And then the bank can then in turn, because remember they're the intermediary, they can in turn do what? They can loan it out to other people. Public savings, if possible, would be when there's additional money available. Now, how would there be additional money available? This would mean that the amount of money that comes in taxes minus the amount the government spends is a positive number. If the amount that comes in taxes minus the amount the government spends is a negative number, then that in turn does what? It reduces the amount of national savings there is available and thus the supply of loanable funds. Because what's the government doing if they don't have enough money? If the government is spending more than they bring in taxes, they have to get that money from somewhere. And where they're getting it in a closed economy is they have to go out and pull it off the loanable funds that could be used for something else. So remember the supply and demand curves as they stand always? Well, the supply curve looks very similar here. But now what we have is we have interest rates. If you look at this graph, you can see 3 to 6, and we have loanable funds going from 60 to 80. So at 60, the interest rate is 3. At 80, the interest rate is 9. What does this mean? This means the supply of loanable money increases as the interest rate increases. Why is that? Because as the interest rate increases, it makes savings more attractive. So now, because remember, we're always looking at our opportunity costs, the opportunity cost of spending money today on something becomes higher because you could save that money and indeed get a higher interest rate. The demand for loanable funds comes from the investments. Firms borrow money that they need for new equipment, factories, etc. Remember, in this particular case, when we talk about investment, we're talking about capital investments. Now, people such as ourselves also make investments. We make investments in things like homes. So there are two kinds of investment that loanable funds are used for. The first is the firms, and the firms would be making investments in new equipment, factories. And remember, new equipment could be computerized systems, it could be the internet, it could be expanding bandwidth, it could be increasing your delivery drivers. Those are all capital expenditures if you're buying new equipment. However, households also make investments. And one of the biggest investments we make, of course, is the purchase of homes. The demand curve is looking at the demand for loanable funds. So now what we're doing is we're looking at a very similar demand curve. So for instance, as interest rates go down, let's start, say they start with 7. At 7%, the amount of loanable funds that were demanded was $5 million and $50 million. However, at 4%, the demand for loanable funds becomes 80 million. Why? Because in general, as the interest rate goes down, it becomes more advantageous to borrow. So more people are going to borrow. So for instance, if you think about the economy and you think about a situation where the Federal Reserve might reduce the interest rate, then one of the reasons why they might do that is to stimulate the economy. We will get to that later. But if you think about it from a personal perspective, if you were thinking about buying a house and the interest rate used to be 3% and now it's 1%, you might be more likely to buy that home. Thus, it increases the amount of demand on loanable funds. The equilibrium, just like all before, becomes where the supply and the demand intersect. And in this particular case, it's at 5% interest rate and $60 million worth of loanable funds. LF is what they call it. So the interest rate adjusts to equate to where the supply and demand are at equilibrium. The equilibrium is going to always be the same. In other words, the equilibrium quantity for the loanable funds is always going to be equal to the equilibrium investment and the equilibrium savings. Sorry, that sounded kind of funny. So what happens? Well, if you have a tax incentive and you go out and you as a government want to get the savings rate to increase in the United States, what you're doing is you are pushing the supply of loanable funds out. So you are literally shifting the supply curve. So a tax incentive that increases savings is going to increase savings regardless of what the interest rate is, right? And so it's going to shift the entire supply curve outward. So what happens is that by moving the supply curve from S1 to S2, by giving some kind of incentive, you end up with a new supply curve. The new supply curve has a new equilibrium. In this particular case, any kind of savings incentive that increases the savings in the United States or any other country will cause more people to borrow or more funds to be available and the interest rate to be lower. So it reduces the equilibrium interest rates and increases the equilibrium quantity of long-run funds available. So if you as a country wanted to do this, what could you do? You could make it advantageous for people to save. So you'd have to come up with some reason to. 401ks were one of the ways that they did this, where they said you can put up to a certain amount of your money into your 401k savings of sorts, and you were deferring your taxes until the future. That was a tax incentive. Now, the second kind of policy that the government can do if they want to manipulate this particular set of things is to have an investment tax. So basically, what are you doing? Your investment tax credit basically allows you to increase the demand. So what they're saying is, hey, if you invest in your business, we're going to give you some kind of deduction. Why are they doing that? Because they're trying to stimulate investments. Now, they could do the opposite. They could tax investments, and then the demand curve would go the opposite way. But if they are making it easier for us to invest, then people would do what? Actually, the demand would go up. So, for instance, because investments in the economic system are capital investments, let's think about home loans. For home loans, if you were to give a tax incentive so that you got a credit on the amount of tax you paid, the amount of interest that you paid on your mortgage, that would be a tax credit, right? Because then every time you paid your mortgage, you would actually be getting a credit. So that would make more people likely to do what? Demand loanable funds. So the demand curve would shift outward. In this case, when it shifts outward, interest rates go up a little bit, but because there's actually more people in the market looking on every single price point, because we shifted the demand curve, the loanable funds do increase. So what does a deficit do to savings? Remember we talked about what a deficit is? What is a deficit? A deficit is when the country spends more than it brings in taxes. If we look at this page here, and we look down at that T minus G, we know that the taxes are a number, and G is a bigger number, so we have a deficit. So what ends up happening here is when we have a deficit, it's actually making that E minus G number negative. So what does that do to savings in general? It's sucking the money out. Because if you think about it and you look at this equation and you look at the two parts, you've got the private savings on one side and you've got the public savings on the other. Your private savings stays the same number, X. But now your public savings, because you have a deficit, becomes a bigger number and the number becomes negative. So even though we have X in private savings, the negative number is going to take away from some of that private savings. So some of that private savings will not be available for the national savings. In other words, there'll be less money available for what? Savings, which thus means there'll be less money available for investments. Deficits have some issues. In our analysis, an increase in deficits causes a fall in investments. So one of the things that people will say is they'll say, whenever the government has a deficit, we are going to see less money available in a closed economy for investment into capital structures. Now remember, let's not panic because the United States is not a closed economy and you can borrow money and there is money coming from places outside the United States. But if the United States was a closed economy in which their money was only the money that was available from savings, then it would indeed be a huge problem. And when we talk about the federal deficit and the federal debt, we'll start to see how this works. But when we start here, we're talking about the fact that we are literally crowding out investments by companies and consumers. And this is what we call the crowding out effect. Because the government is going to borrow and finance its deficit, and it's going to leave less funds available for investment. And in a closed economy, it crowds out other investments. And remember, investment is important to long-run economic growth. So, budget deficits reduce economy's growth rates and future standards of living. And that's one of the reasons why when we look at the overall numbers in the United States economy, we aren't just looking at the GDP and the consumer price index and the inflation rate. We also have to look at the deficit, and we also have to look at the savings rates, and we also have to look at the public and private savings, and we have to see whether the national savings is, because we can crowd out other investments, and then we have to go elsewhere to get the money, which means we're going outside the United States. The U.S. government's debt is financed by what? Borrowing. We finance a deficit, which occurs every single year, by borrowing. We borrow what? We borrow money. The way that the government borrows is we sell bonds. A bond is not a piece of stock. So we are not buying a piece of the U.S. government like you would of a stock, because a stock is buying a piece of a company, right? A bond is basically a promissory note, right? An IOU. It's saying that we are going to be able to pay back at another time this amount of money. It could be a zero coupon bonds, which is usually what the government does, where basically you buy it for $50 and it's worth $70 upon maturity. Persistent deficits raise the government debt. The debt is a combination of all the deficits put together. So, as you can probably imagine, economists like the number, which is the ratio of the government debt to the GDP, because it allows you to see how in debt the government is versus how big it's growing. So then, if you think about how big it's growing, what's the growth doing? The growth is creating tax revenue. So you can kind of start to see whether or not a government and an economy is able to get themselves in or out of a hole. Because if you know what their GDP is and you know what their ratio to debt is, you can say, okay, well, this particular government may have some debt, but its economy that is supporting as a government of that economy is huge. So that debt is not pulling down the economy. However, if your economy is smaller, it can pull down your economy. Now, historically, as you probably imagine, during war times, the debt to GDP ratio increases and it falls during peacetime. It also tends to happen during other times, such as any type of national disaster. However, in the early 80s, everything changed. In the early 80s, we started to spend more money than we were bringing in. This is in fiscal year 2019, and this is a composition of the federal spending. And you can see this is what we spent our money on. So we spent our money a little bit on interest, defense discretionary, domestic discretionary, mandatory, things that we have to spend money on, Social Security, and other major healthcare. Where we brought it in, as you can see this smaller graph on the other side, is other taxes, Social Security, insurance tax, and individual income taxes, which would be all of us. And then I think this black one is the corporate tax. So in 2019, we had a deficit of $897 billion. So in conclusion, like many other markets, financial markets are governed by the forces of supply and demand. We learned that. And we learned that there's ways in which policy can affect the supply and demand curve and have it shift one way or the other. Markets are usually a really good way to organize activity. So it makes sense that it would be a perfectly fine way to organize the financial market. The financial market helps allocate the economy's resources, our scarce resources, how much loanable funds we have across the people. And financial markets link the present to the future. They enable savers to convert current income into future purchasing power, right? Because we're able to take that, save it, and then with interest, hopefully we'll have more money in the future so we can purchase more. And borrowers can acquire that capital to produce goods and services for the future. So in summary, looking at this chapter as a whole, you can see that the financial system is made up of quite a few different financial institutions. There's the stocks and the bonds. There's banks. There's mutual funds. We're going to need to know what each one of them does. The national savings is equal to the private savings plus the public savings. And then we talked about what if the public savings is in a deficit or we're in a surplus. And in a closed economy where there is no imports and exports, and remember, imports and exports are not just goods, they can be money, the national savings is equal to the investment. So the financial system makes this happen. It makes the difference between these two actually occur and allows us to do what? Invest. Thanks, guys. See you next time.